To Module 3. Chapter 3 is all about taxes. In this module, you will be listening to a podcast about the history of income tax, and I hope this helps humanize the world of taxes a little bit. I personally don't care for the topic of taxes. As a business owner, I feel the burden of time when I'm trying to file various returns and all the many required schedules. At year end, I'm easily feeling the huge paper trail of fourth quarter and annual returns that leave me in a less than pleasant mood. While I understand the necessity of the financial aspect of taxes, I am easily overwhelmed with the ever-changing tax codes and documentation. If you're an employee, the tax requirements do seem a bit easier to manage. If you're self-employed or own a business, I strongly recommend consulting an accountant to enable proper budgeting for taxes and compliance with the multiple entities of state and federal government. But remember, even if you hire an accountant, you are ultimately responsible for supplying accurate and complete information for filing those returns. I'd like to review some common tax forms with you. Your textbook does a pretty good job of reviewing these, but the IRS loves using long series of letters and numbers for their jargon, and a couple of these key items that you should know I'd like to go over. So the first one, W-4. This is the form that you complete when you start a new job. This form lists your name, address, social security number, and perhaps the most important for tax purposes, your number of allowances. The more allowances you list, for example, your children or dependents, the less money is withheld each paycheck. If your spouse earns significantly more than you do, or is self-employed, then claiming all of the allowances may prevent you from deducting your full tax liability throughout the year, or you could end up owing taxes at the end of the year. Some people will choose to claim less dependents than they actually have, just so they don't end up owing taxes at the end of the year. There are many opinions about this strategy, with most financial consultants recommending against this option because of the time value of money. The idea being that by doing this, deducting more than the necessary each paycheck is the equivalent to putting that money each month in a non-interest-bearing savings account. Still, many Americans use this strategy and enjoy a refund rather than a bill in April. Employers are required to mail your W-2 before January 31st of each year. The W-2 is a statement of all your earnings and the withholdings that you had. If you weren't an employee and were instead a subcontractor, you'll receive a 1099. A 1099 is always reportable on your tax return, regardless of the amount. Any payments a business makes to an individual over $2,500 is required to be reported on the 1099 form. The business not only sends you a copy, but they also send a copy to the IRS. So ignoring this form on your tax return is certainly not advisable. Most of you will receive a 1099 for interest in your bank accounts as well, or especially in this area, any pickup weekend work. So even if you have a regular job that you're receiving a W-2 for, if you're doing weekend work for a contractor, painter, landscaper, boat repair, any place where you weren't technically a full-time employee, but instead working as a subcontractor, you'll receive a 1099. If you're being paid by check without any withholdings, this should be a red flag to you that you should be anticipating a 1099 at the end of the year. You'll have to pay your taxes on that money at the end of the year, and if you owe the IRS too much money, you'll be hit with penalties. If your full-time job is as a subcontractor, you really should meet with an accountant to make sure that you're managing your tax liability properly with quarterly tax payments. A lot of people will instead use online programs such as TurboTax to help them estimate these quarterly tax payments. Ignoring the situation until the end of the year will most likely result in penalties. At the end of the year, you'll most likely file a 1040 or 1040EZ, depending on your financial situation. If you own a business, you might file a Form 1120. It is on the Form 1040 that you will list all of your deductions. Deductions are amounts that you are allowed to subtract from your income before calculating your tax liability. For most of us, this includes medical, dental, automobile tax, property tax, charitable contributions, certain educational expenses, and whatnot. You should always hold on to your receipts if you plan to claim these deductions. The IRS even recommends recording your mileage with a log if you are deducting travel to doctor's appointments or travel to volunteer at charitable events. This is extremely time-consuming, but if you are audited, it would be nice to have all your ducks in a row. Another deduction used around here is for storm damage. I know we personally had significant storm damage after Irene, and the amounts that were not covered by insurance were deductible. Again, this needs documentation, so keep a file for costs due to storm damage or any theft or any other unusual disaster such as a tornado. Here are some other ways to reduce your taxes through deductions. Municipal bonds, savings plans that are 529 savings plans. Those are educational plans. If you're setting aside savings for maybe your child or your nephews or nieces. A 401k plan, that's the retirement plan that you might be part of if you are a full-time employee. Often the employer will match your contributions, so they're a fantastic deal if you have them available to you. A traditional IRA is usually what people use if they are self-employed or own their own business and are not don't have access to a 401k plan. You can actually contribute to your IRA in addition to a 401k. Remember, Roth IRAs, there's a distinction between IRAs and Roth IRAs, and we'll get into that later. Roth IRAs are not deductible investments. Traditional IRAs are deductible, but Roth IRAs are not deductible. There's a lot of other deductions, interest, charity, medical, child care costs, interest on your home equity loan, teacher supplies, like when elementary school teachers purchase classroom supplies, those are deductible. The list goes on and on, but again, documentation is really key here. So if in doubt, save the receipt, throw it into a tax folder, and see if it qualifies when you file your return. The last thing I'd like to go over are a couple sample problems for calculating taxes. Take a look at this table here and try to figure out what the tax liability for an individual with a taxable income of $20,800 would be. I'd like you to pull out your calculator and figure this out. Please put this PowerPoint on pause to calculate your answer first. Your answer should have been $2,695. For a person who earns a taxable income of $20,800, their tax liability would be $2,695. How does your answer compare? A common mistake would be to arrive at an answer of $3,120. Did you get this? If so, you probably simply calculated 15% of the income. This is not the correct way to use the table. You should have calculated the answer like this. We have 10% times 8,500, and then you have 15% times 20,800 minus 8,500. So we're looking at taxing 15% on the difference of your income minus that first $8,500. So the first $8,500 is taxed at 10%. And the next chunk of money is going to be taxed at 15%. If that person's income was going to exceed $34,500, the remaining would be taxed at 25%. Say they made $100,000, then the next chunk's going to be taxed at 28%, and it keeps going up from there. If you calculated this correctly, you would have had $850 plus $1,845. That represents the amount that was in the 15% tax bracket. And your total taxes would be $2,695. Let's try another example. Same tax table here. What would the taxes be for an individual with an income of $30,000? Put this lecture on pause if you need to figure out your answer. You should have arrived at $4,075. Same thing, we took that first $8,500, that was in the 10% tax bracket. Then we took the rest, that was at the 15% tax bracket. So we should have $850 plus $3,225. The total taxes are $4,075. Take a few minutes to calculate your own estimated income tax using this table. Keep in mind that the federal taxes are always separate from North Carolina taxes. Our state tax system has its own regulation for tax rates and what's deductible. Some things that are deductible for the federal tax return are not deductible for the state tax return. At the end of the year, you will file returns to both entities. Do you feel that your tax liability is fair? Think of the benefits that you receive with your taxes. Our roads, fire protection, police, beach nourishment, public schools, even your college tuition is subsidized through these taxes. Do you feel you're paying your share of the resources you use? Based on your income, do you think you should be paying more or less? We'll be exploring this idea a little bit more in our discussion board this week. This concludes my lecture. I hope you enjoy this unit and complete it feeling a little less mystified by our tax system. If you have any questions, let me know. Thank you.